Hello, and again, I'm Daniel Kirsch, and we'll come back to this discussion now of presidential leadership and policy. We're going to be talking not only about the difference between fiscal and economic policy, but also the president's role in fiscal policy. It's kind of a big bucket to put a lot of things in, and so is economic policy. They're certainly related, and anyone who's taken an economics class knows that they're part of the same conversation about money and people and politics in the United States. However, there is a distinct difference that I'm sure you all are aware of, but it's worth stating out loud to kind of warm up the lecture today. And one is that fiscal policy is just taxing and spending. It's taxing whatever people have and then spending, whatever the government has for whatever priorities have been passed by Congress. That's it. Everything the government takes in, everything it spends money on, and all the decisions and all the conversations and all the technicalities related to those things. And economic policy is anything that relates to the wider economy, and we're going to get into what some of the mechanisms are that actually deal with the economy at large and aren't just about individual government programs. And when you talk to ordinary people on the street about what government can do, one of the first things they say is, well, they can cut our taxes. Because they just spent a lot. They just spent a lot of branding on the last 4 years about that, and really not just the last 4 years, the last 40 years. You hear a lot, especially from the Republican Party, about how much taxes can always be cut. But before you do a tax cut, you should know that they've become so central to political messaging, and that Republicans often can talk about little else that is something that their entire party agrees on. And as far as the Democratic Party, they've gotten into the fashion as well, right? There's been a lot of tax cuts on the Democratic side, especially during the Clinton administration, for example. One of the more prominent and longer Democratic administrations there have been. Bill Clinton had several tax cuts that he trumpeted where he worked with the Republican Congress to accomplish. But Democrats tend to talk more about the need for tax revenue and the need to be able to pay for public policy priorities. And ultimately, even though, President Trump did sign the Tax Cuts and Jobs Act in 2017, and I haven't looked at all the polling on this, I believe more people had their taxes go up than had their taxes go down as a result of that act. So tax cuts have become a little bit different than they initially were intended for, it seems. So even though it was kind of a net cut in taxes or revenue, a cut for the government's revenue, and it was a tax cut, certainly for people who paid a lot of taxes already, and that is in the highest income bracket, and a lot of people, because they were, their taxes went up because a lot of tax loopholes closed. And there were a lot of deductions that were eliminated. A lot of people, especially making less than $100,000 a year, saw their taxes go up. And so that's not something I think a lot of supporters of President Trump at the time expected. And so that's not something I think a lot of, so it's maybe one of the reasons for not winning re-election. It has to be. So anyway, taxes have been central not only as a fiscal tool and as an economic policy tool. Also, I'll talk more about interest rates and how they relate to the economy as a more central actor, because they're what economists consider to be much more functional as a part of whether the economy itself is stimulated. And so even though the Treasury Secretary, as an advisor to the President, and the House of Representatives as an originator of tax bills have roles to play in economic policy, it's more that they have to do with fiscal policy. They're more to do with the kind of central part of that conversation. I should also mention that the Biden tax bill also cut taxes, and actually also did expanded the earned income tax credit for poor families and taxpayers. They actually got and not even poor. It's actually under a certain threshold of income, it's like under $80,000 or something, um, people get actually an earned income tax credit per child. So it is primarily aimed at families with children under 18, and they receive a certain amount of money, not every year after the taxes are filed, but sort of preemptively, automatically every month based on last year's taxes. So so it's actually a very this kind of negative income tax almost on some folks who have earn less than something like $80,000 a year and have children under 18. I'm probably getting a couple of those numbers a little bit off, but that's the basic thrust of the bill. So there has been a little bit more messing around with the tax code in the Biden administration as well, but they seem to be after a different constituency in as beneficiaries of those policies. As far as spending itself is concerned, and all of spending in fiscal policy, the approximate number of federal government spending every year is around $5 trillion, and that's kind of disregarding pandemic politics and kind of higher spending levels in years that are meant to be exceptions. But on average, in the last 5 or 6 years, the average amount of money that the government has been spending is about $5 trillion. And so the coronavirus relief packages, the various ones from the Trump administration, the Biden administrations, were attempts to, not only stimulate the economy, but also assist in the recognition that the economy is not the only thing that the government serves, right? It serves the people who are in it. And I think it's meant to spread around the priorities of not only stimulating the economy, but helping folks who have been hit hard by either the pandemic itself or by the social situation it's created. So at one point, truly it is going to be quite a heavy burden on the national debt. It's going to add just about $2 trillion probably to the national debt, which is about $20 trillion right now. So it's not really central to the conversation right now during what is still considered to be the pandemic. But I would say at some point in the relatively near future, maybe a year or two, we're going to start to see conversations about what kind of drastic cuts are needed to be made in federal government spending in order to make up any sort of gap in the deficit toward budget balancing. So the debt's not growing quite so much, and maybe we'll get there. But it's kind of a matter of let's wait and see at this point as far as the budget is concerned. And every year the budget is agreed upon by the Senate, the House, and the President. And every year there needs to be a budget deal. The President has to agree to a budget, even though the word deal is not in the Constitution. The President has to sign something that the majority of House members and the majority of Senate members can agree to. So they all agree that these are the spending priorities according to the entire apparatus in Congress of committees that oversee all the executive agencies and see the spending priorities of the last fiscal year and try to amend them and update them for the next fiscal year. So if everyone can agree, then we can have a budget deal. And if they can't reach a deal, which is unlikely at this point because we're still working with a Democratic majority in the Senate and the House, it seems like they're kind of marching in lockstep for most things, although there are a few holdouts on the Democratic side in the Senate particularly. But if they, for some reason, were to have a disagreement between the branches about what the government was going to spend money on for that year, then after September 30th, the government would get shut down. And the book corrected me. There was a couple of government shutdowns in the last couple of years. In the book and another resource I found online, there was, I think, 3 government shutdowns in the last 5 years. So just one was a month long, and the others were shorter than that. But there have been shutdowns where they furlough non-essential workers, and those spending priorities that are in conflict are something that there's a whole budget process that's multifaceted. It starts with a link I can send you, but it starts with the president sending out budget requests to all the agency heads, and they send a new budget request that year to Congress for the agency that oversees them. and then it eventually gets referred to committees like the Budget Committee, the various authorizing committees like the Agriculture Committee, the Defense Committee, and this is in the House and the Senate. So the Agriculture Committee, the Transportation Committee, the I don't know, the State Department Committee, like the Foreign Affairs Committee. I mean, and several other policy committees that have kind of a wish list, and ultimately it all gets cut to a certain degree, but also added to by the Appropriations Committee and then signed by the President and agreed to by the leadership. So, so I mean to say that the shutdown takes place as long as there's no deal and there's someone attempting to negotiate for something that was not included in the budget deal, and that's sometimes it's one or two senators, but often it's a large kind of group of senators or representatives who feel that their concerns are not being addressed, and they do everything in their power to stop the process that they don't appreciate from continuing. And that's the system that we have, and not every country has a system like that where a single senator or a group of senators can hold policies up like that and hold the entire fiscal process up for a year, but we do. So besides the Senate and the House and the Finance Committee, there's also several other committees that I won't kind of bother repeating, but the Budget Committee puts together the House and the Senate budgets, respectively. And that's in some ways the start of the conversation. So even though the Ways and Means Committee in the House and the Senate Finance Committee pass revenue bills about tax collection and some spending bills on things like Medicare and Social Security, most things kind of take place in the Budget Committee, or at least originate in the Budget Committee. And what they put together is an important stage because they put together all the different budget proposals from the different agencies, and they reconcile them. And they kind of have the first real draft of a congressional budget. And so the Budget Committee and the House and the Senate are able to really set the agenda in a real way before it's implemented and before it's passed. But as you've seen with the Biden administration, there's a lot of activity that takes place that seems to go around in some ways the normal budget process because it incorporates it, but it also sort of supercharges it in the first 100 days of an administration. So the first 100 days of the first year of the first term of an administration, those first 100 days out of 1,200 days, something like 14 or 1,500 days. But those first 100 days, is typically when a lot of things happen. And why is that? Well, 100 days started out with Franklin Roosevelt. It's in your book, but it started out with Franklin Roosevelt kind of sending 15 bills that were passed through Congress in the first 100 days of his administration. That's it. So these were pretty not radical bills. They were pretty wide-ranging but ambitious bills. And President Roosevelt was kind of setting the tone for those 100 days. Since then, really every president has used that period as a honeymoon period to be able to prove their effectiveness and their leadership. And as you know, whether they usually have a pretty cooperative Congress to be able to do that in the first term, or at least the first 2 years of their first term. But that's not always the case. So it's not really to do everything economic that they want. It's 100 days to do some fiscal things and to address some economic concerns. And so what can a president really do economically? Well, the president can be more like the budget committees. They can kind of set the stage for the economy to be improved, but no one really controls the economy. The Fed chair, the Federal Reserve chair, is certainly more active in attempting to speed up or slow down activity in the economy. But what does that mean? Well, interest rates are their main tool, setting the interest rate. But the Federal chair of the Federal Reserve, the chair of the Federal Reserve, is someone who is appointed by the president, and they serve a 4-year term, but they're not strictly speaking a government employee. They're legally created, but they're self-funded as an office and an entity, but they function like a bank. And they're, in many ways, they're our national bank. But that person is appointed, the head of it is appointed by the president, and they serve a 4-year term. And you may recognize some of the names that I'll list here. I'll just mention a few from the news. So you've probably heard these names that are at least mentioned in the last 5 or 10 years: Alan Greenspan, Ben Bernanke, Janet Yellen, and Jerome Powell. Um, he's probably the least visible of all, but he's the current Fed chair. He was appointed by President Trump, and I know very little about him personally, except that he's a close associate of Janet Yellen, the previous Fed chair. And she's now the Treasury Secretary in the Biden administration. She's about 80 years old, I believe, but she's had a long career, but mostly as an academic economist. But now she's the Secretary of the Treasury, in charge of taxing and spending, and in charge of advising the president on fiscal and economic policy. Let's see. So the Fed chair is kind of they're the kind of lender of last resort. And as the lender of last resort, they lend to large banks, particularly during economic crises, and they set interest rates on those funds that they lend to the largest banks, largest commercial banks. They basically create incentives or disincentives to lend money by banks, from large banks, and that kind of trickles all the way down to smaller banks. And then just to borrow money and to spend money in the economy, not by just the government, but by everyone. The problem is they run into a lot of problems with doing that. And one of them is that, as you know, is they set the interest rate too low in a recession, for example, which is their kind of primary weapon. During recession, people are out of work and people lose money. And if they want to stimulate the economy, they lower interest rates. Well, what if your interest rates are at zero and there's a recession? That had never really happened before the Great Recession in 2008 and 2009. Interest rates were near zero anyway. So they had to start a program called Quantitative Easing, and without getting into it, I promise, it's basically like negative interest rates. It's basically paying large banks, like giving them a bunch of money to loan out more money, and paying them to take money from them, paying the banks to take money from the Federal Reserve. So they're still giving out loans, but they're kind of incentivizing them to give loans to smaller banks. So let's call it a cash bonus to a lot of large banks. And so that's what quantitative easing is, in a way, probably an unfair nutshell, but that's kind of the flavor of it. And the president really had to be on board. George W. Bush and then Barack Obama both had to be on board with this policy in order for it to work popularly. But they're also probably powerless to what the Fed chair actually wanted to do. The Fed chair is the chair of a committee called the Federal Open Market Committee, which in and of itself is a subcommittee of the Board of Governors of the Federal Reserve. Anyway, so it wasn't always central to one person, but the chair today is really the person who makes these decisions about whether or not to raise or lower interest rates every quarter, every 3 months. And so the president can really only appoint that person, and the president cannot fire that person once they've been appointed, and the president cannot call for an impeachment, even though they're not properly a federal government employee. It's a very strange kind of arrangement. It's not really something that they're very much an independent actor that's appointed by the president and confirmed by the Senate every 4 years, but as someone who typically testifies before Congress as the chair of the Federal Reserve, they're a person who's seen as the guardian or at least a guardian of the economy. They're the ones who try to keep everyone employed and happy. The difficulty with trying to get inflation under control, which is one of their primary kind of weapons, is there's an argument by many economists that maybe by trying to be so controlling about inflation, it's not allowed for the kind of natural growth in the economy. And so keeping interest rates low in order to stimulate growth is really what a lot more economists are calling for these days. But if you keep interest rates high, or just on the higher side, you stop inflation, but you also maybe stop a recovery from happening. You disincentivize people from spending money, but you also disincentivize people from borrowing money. So then you have sort of a crisis. And so right now, it's worth saying that the economy seems to be going pretty well as I record this, in the winter of 2021. But also there's a very high inflation rate that's happening, about the highest in 40 years, about 7%. So we'll see what turns out with that. So the president really can have influence over the debate, is kind of what I'm saying here. They don't always participate in quite the way that you want them to, but the president at least uh, there's at least been a balance struck by the research at this point. So just because a president is elected on a pledge of saving the economy doesn't mean that they'll be able to do it. And it certainly doesn't mean that even if the economy is safe while they're in office, that they necessarily deserve credit for doing it, because the Fed chair, as you know, has to make a decision every quarter about whether to raise or lower interest rates, which has just this outsized impact on the economy. And there's literally very few people on earth that have their decisions scrutinized as much as a Fed chair every 3 months, and second guessed as much as a Fed chair over whether to raise or lower interest rates, because you'll see it next time it comes up. The next time it will be, December 31st. Right now, because I'm recording this, of course, in December. But the next time they raise or lower interest rates, but it's quarterly. But as you know, they're trying to either keep them steady or keep them low at this point. So I think they're not back into quantitative easing territory at this point. But they had a zero interest rate for years in their loans to private banks after the Great Recession. So in terms of loans, you might be asking where the money is coming from. Nobody really knows. It's sort of just based on the economy, the faith that people have in the economy. The Feds, they see that as part of their mission. The reason that inflation needs to stay under control is because all bets are off if the value of money inflates and kind of weakens. Because the source of American power and influence around the world, the basis of that, at least one of the bases of it, is the American dollar. And so, there hasn't been really runaway inflation really in a very long time. And the last time we ever had higher inflation than we do right now is maybe in the 70s. There was about a 14% inflationary rate in, I think, 1973. Nixon and Ford really had to work hard to get that under control. And they appointed, a couple of Fed chairs that tried to work on it. And finally, Jimmy Carter, a Democrat, was elected, and he appointed Paul Volcker, who was one of the people who started to work at really lowering interest rates by not constantly trying to stimulate the economy by cutting interest rates. He raised them to slow things down. And a lot of people certainly, jobs weren't as easy to come by. They weren't as, so that's why tax cuts began to be the way that the economy could be stimulated, because the Fed was deciding not to stimulate it themselves. So the kind of 1970s and this kind of reaction to high inflation is something that really began the chain reaction of popularity of tax cuts. So economic policy, in a way, if economic policy is not doing what people want it to, then fiscal policy is seen as kind of the little that democratic levers can really control. So that's how they're related. So this has been more of a conceptual look, I guess, at fiscal and economic policy than a specific one. But your textbook is very good at detail, so I would encourage you to look more at that. So again, the main players in all of this is the president, of course, the Treasury Secretary, who's an advisor of his, and then there's the Fed chair is someone who can raise and lower interest rates, who's appointed by the president, and they raise and lower interest rates for banks and thus create incentives to loan money. But the House and Senate, their only role is to tax and spend, and at a rate that is clearly dependent on the economy and whether people think that they can afford to spend money or can afford to not spend money. And by they, I mean people who kind of have influence over government spending. And so many people would have liked to have seen a higher commitment of government spending by the Biden administration, certainly by the Trump administration as well during the kind of coronavirus crisis. But a lot of people saw that as an overreaction, what they did. So there is definitely a middle ground being struck, and of course the people who are who are talking about not enough money being spent generally are on the lower end of the economic spectrum, and the people talking about wanting more, wanting less done, are people who already have resources and can weather this kind of crisis. So take that for what it's worth. But let me know if you want to discuss any of this, and I'll have some questions for you to mull over in your discussion board posts and your essays in reaction to both my lecture and the book itself. Until then, thanks for watching.